Welcome to our last session of the day on the main stage, where we get to talk about REITs and all the unique and fun different things that REITs deal with that some of our other investor clients and landlords don't. And so let me introduce our moderator for today, Ted Jones from Stewart Title, Executive Vice President and Chief Economist, and most importantly this week known as our host for the ringing of the opening bell of the New York Stock Exchange. Many thanks.
It was a lot of fun. Much appreciated. Well, I am Chief Economist from Stewart Title. I'm the appraiser on the panel, so to speak, up here. Don't hold it against me. We've got a great, talented crew on this REIT panel. We've got Jason Fox. He is the president of WP Carey. We've got Wilson Eglin, CEO of Lexington Property Trust. Mitch Rudin, CEO of Mack Cali. And we also have Mike Landy, CEO of Monmouth. So what we're going to do is we're going to do just a question and answer, comments. They may not want to answer. They may want to talk, and they may talk more, and they may want to ask a different question. So we're going to let these experts do that. So, gentlemen, let's talk about, first of all, we'll do triple net, single tenant properties, which several of y'all are involved in, some of you are not. Just today, one of my tweets that went out, the Boulder Group noted that single tenant, triple net retail properties are at almost an all-time record low cap rate, 6.10%. They said that industrial was 7.14%, and office 7.08%. Now, first of all, it's a great product, correct?
It's a good product.
Absolutely.
Yeah.
And it's a product that's in tremendous demand by investors.
For sure.
That's true also.
So even as we look, and I think generally we all expect interest rates to go up some, I think we would disagree on how much and when. What about rising cap rates? What's that going to do to this business?
Well, you have to be a little bit mindful of, if we have rising cap rates in a rising interest rate environment, in theory, all of these long-term revenue streams that we acquire can become devalued as a result of higher interest rates. But on the other hand, recently the biggest risk in the business is what the real estate has been worth at the end of the lease term. So to the extent we have a growing economy and some inflation, that if there's a correlation between inflation and interest rates being higher, then arguably the biggest risk in our business, which is what's the value of the real estate at the end of the lease when it's empty, that risk would be mitigated. So, if you have a big portfolio like we do and like WP Carey does that has diversification with respect to lease expiration, you should be reasonably well leveraged to the economy if we end up in a growthy and higher rate environment.
Yeah, I mean, I'd say I'd welcome rising cap rates at this point in time. I mean, it's difficult to be a buyer of a lot of assets out there. Even at market rents, if your tenants are in at market rents, the basis at which you need to buy, given these cap rates, is just hard to justify in many cases. It's, we like to be discounted replacement cost. In many cases, there are situations, especially with, structured deals when you have term on your lease and a credit that you believe in, that you may be willing to go higher. But by and large, it's hard to get into assets at these cap rates where you're not meaningfully above market. So I think we welcome it as to the existing portfolio. It'll have some effect on valuations, but as Wilson said, a lot of what we have are leases indexed with inflation, and to the extent you believe there's correlation between rising interest rates and inflation, then I think you're going to see some appreciation in your assets as well at the same time.
What I think is interesting, both you added, was the diversification factor that a larger REIT can have because of the varying expiration dates, renewal dates. And so what you're telling me is big is better, particularly when it comes to one of these, if you've well diversified in that calendar schedule.
I think especially in the context of owning single tenant real estate, where the risk is whether the building is full or empty, either as a result of lease rollover or a credit event. So you should be able to buy single tenant real estate at a higher cap rate than comparable multi-tenant property types for that risk. And if you can diversify enough and get enough size, you should end up with something that should be valued by the public market as more of a proxy for multi-tenant or like a mixed-use park versus just a single-tenant asset. So diversification is really important.
Last question on this one. What about the diversification geographically? Some of you are pretty much localized in what you do, and some of you are global almost. So what impact does it have on your future investment strategy decisions? Are you searching out those secondary and tertiary markets that have more attractive cap rates already on the purchases, or are you just, or on new construction? Or are you just going to specialize in your own markets because you know where to make money?
Yeah. I mean, we're opportunistic in our approach to new investments, and especially in net lease, where we're focusing on, 15+ year leases. We think that this sector, long-term net lease, probably has the most transportable model to go into different geographies, into different asset classes, into different tenant industries. And so that's what we've done. We're opportunistic. We look to allocate capital where we see the best risk return opportunity. In 2014 and 2015, at least on the public REIT side for us, we were much more heavily allocated towards Europe. There were great spread opportunities there. Interest rates were very low, borrowing costs were very low, but there still weren't the capital inflows into that market for whatever reason. A lot of the Middle Eastern and Asian funds weren't coming back yet. A lot of U.S. investors weren't willing to go back. So we saw some great spread opportunities, 500 basis point spreads, and for us that's quite good. That's come down substantially in 2016, and we're going to kind of reverse that allocation. We're going to see much more investments on our balance sheet in the U.S. this year as opposed to Europe. And so, geographic diversification gives us the opportunity just to find where that best risk return opportunity is.
I think the simple answer for us is that we follow corporate users. So we do invest in secondary and sometimes tertiary markets if we have a long-term lease and a high-quality tenant. But we tend to, at least in our office portfolio, we're tending to focus on markets where there's a large depth of corporate users. So if we have a vacancy, it won't be hard to backfill. But in a long-term lease, so much of the return comes from the rent, and it does allow you to go into smaller markets for the right opportunity.
So I've always said, wouldn't it be nice if someone rung a bell at the top and bottom of the market? And I'm going to take you back to when Sam Zell rang that bell at the top of the office market. But we still have great opportunities in office markets today all over the country, except perhaps Houston, Texas, where oil and gas glut's kind of taken us downhill from there.
Well, I'll jump in, and I'm not sure how many of you are familiar with Matt Kelly. People know us. Hands up. We're in a different business. I'll just spend a minute on it because only about 3% of you raised your hands. We're a dual platform company focusing on office and multifamily, heavily along the New Jersey waterfront and in other transit-oriented markets. On the commercial side, when we're done rationalizing the company, we will be in New Jersey, in Westchester County, New York office, and on the multifamily side, we will be heavily in New Jersey, 5 other states in the District of Columbia. We took a different strategy when we stepped in. We had a scattered portfolio, and we made the decision that we were going to dial it back to markets not only that we were comfortable with by knowing them, but markets that we saw potential in. And when we first started, we were joking about it. Some of your questions sounded like it was for an analyst. The nature of the research for New Jersey is that unlike New York City and a number of the other markets where they subdivide markets into rational ways, New Jersey is pretty much dealt with northern and central, and then southern being something completely different. And northern New Jersey encompasses everything from Hoboken and Jersey City to Saddlebrook to Paramus to Parsippany, none of which has in common. So we'd start many meetings with, all right, the suburbs suck. What are you going to do now? And so what we had the conversation went that, okay, there are certain submarkets that underperform, and we don't see a future in them. And fortunately, we've been able to exit a number. We also, through our multifamily business, we've been able to repurpose a number. But there are others that perform quite well. In 2 markets in New Jersey, we've broken rents of $50 a square foot, which in any market across the country probably puts you in the top 10. You know, you take out the Bay Area, Washington, and Boston and the suburbs, and we have seen in markets like Short Hills, Metro Park, Monmouth County, 10 to 15% rent growth. In Jersey City, since we started 16 months ago, we've seen rent growth of over 25%.
Wow.
Now, on the other hand, we walked into a building, and I started with a terrific partner, a fellow named Mike DeMarco, 16 months ago, and we committed we would see all of our 225 assets in the first summer that we started. We started in June, and we had committed to deliver a business plan by September. And we went into this building in Saddlebrook, and it was it was a Houston-like day. And we walk into the lobby, and it's just beautiful. And after about 30 seconds, we say, what's going on here? Why is it so beautiful in the lobby of this building? Well, your predecessor insisted that we keep the air conditioning on in the event that anyone ever came by for a tour. And we said, how many tours you had? Well, we usually have one about every 2 months, and we're in discussions with somebody, and well, what are the terms of those discussions? Well, we'll give them the space free for a while. So we said, turn off the air conditioning, turn off the lights, and by the way, and then when we finished it, we said, who's going to rent this? And they said, nobody. And we said, we paying real estate taxes? They said, yeah. Pull your demo permit. But, you know, so that was a market that lent itself to multifamily. So the answer, there are good markets, and others not so good. And it's, you know, in doing those things, and I think we'll come back to the kinds of things that can take a market with potential and make it better.
You know, your comment about Houston is an interesting one, because in the net lease space, right, with long leases and hopefully high credit quality, it can be a good way of investing in soft markets. Right, we have 17 years of weighted average lease term in Houston and high credit quality. So like, I feel, you know, like we're not selling anything. We feel like we're in a good spot.
It's kind of surprising when you see a Chevron or ExxonMobil vacate a structure that they still have 11 years left on their lease, and you know they're going to pay it.
Well, unless they go bankrupt, you're stuck with the obligation, you know.
So I'm going to talk oil and gas. You know, with downside in Houston, Texas, you know, and other markets in the country. Western North Dakota is just, it's originally called the Badlands. It is once again. So let's talk about industrial, because industrial, if you look at NCREIF returns, it's the highest returning real estate segment there is.
Right.
And if you look at what George Mitchell, the guy who perfected, you know, fracking and hydraulic fracking and shale formations, just on the Gulf Coast, we're seeing $331 billion of new construction.
Right.
And even last week, I was speaking from literally Toledo, Lima down to Akron,
Right.
that car parts corridor. Those are the 3 highest job growth cities in the entire state of Ohio. They're doing extremely well. Tell me about the industrial properties with y'all, because that's what your specialty is, and where it goes from there, and how you see opportunities with cheap energy prices springing back in and making yours that much better.
Great, great. I appreciate the question. I'm going to pivot and talk about Vladimir Putin first. No, I'm just kidding.
Puppet.
That's a great question. I love your question, and I definitely want to answer it. Monmouth Real Estate is single tenant, net lease industrial properties, long-term leases to investment-grade tenants. We own about 7-8% of the FedEx ground network in the US. FedEx is now benefiting from the revolution of consumer spending migrating from bricks to clicks. Walmart is building millions of square feet next to our FedEx ground facilities. We own a lot of non-FedEx assets that piggyback off of our FedEx assets. We're in 30 states, coast to coast. But like Rudy Giuliani said, you know, if you're hostile to business, people flee for the hills. And he turned New York around by being business friendly and reducing taxes. And that's how we invest. We look for locations that are business friendly. California tends to be less so. We're not in California. You mentioned fracking. You know, we're long-term thinkers. As public companies, there's this propensity to ever decrease your investment horizon. It's never been, we're in an era of high frequency trading, and the investment analysis is being shortened increasingly. And we invest where the future growth is going to be. We saw that consumer spending was going to migrate from Main Street to cyberspace. We agree that fracking has the Marcellus Shale, the Utica Shale, those areas. Oil was first discovered right in Pennsylvania. They have more reserves in Pennsylvania and Ohio than Saudi Arabia. And because of hydraulic fracturing, this technology now can exploit these reserves. And it's not happening today because the cost of oil is so low, and that's a result of the abundant supplies. But we invest for the long term. We're in Houston, we're in Corpus Christi, we're in the Gulf of Mexico, we're up the eastern seaboard, Tampa, Miami, Jacksonville, Charleston, Norfolk, et cetera. And now with the Panama Canal, that's, nobody's going to be held hostage every Christmas season by clerical workers going on strike at the Inland Empire, bottlenecking the whole global supply chain. So we think we're really well situated to benefit from both the shift from, we're in a 1% growth environment, GDP, but e-commerce is growing 15, 20%. You want to be where the growth is. It's anemic everywhere else. And then from a location standpoint, with the Panama Canal, with business-friendly locations, we feel we're strategically well positioned.
So we're going to talk about business. Did anyone else want to add to that on the industrial side? We're going to talk more about literally your specializations and what have you in a little while. But let's just throw the open ball of millennials into play. Now, I'm a boomer, and you're a boomer if you're born between 1946 and 1964. There's 76 million of us boomers, and we're all going to die. The good news is, though, on the millennials, literally from the ages of 19 to 35.
I was going to say the good news is not for a really long time.
For a really long time. Well, the good news is because the good news is we have a larger population of millennials just between the ages of 19 and 35. There's 83 million. If you go down to the age of 16, there's 91 million. And they're just entering that stage where they're buying stuff. And so how is this millennial, the largest population demographic the U.S. has ever seen, how are you situating your corporate strategies to really tag onto that for the maximum growth? Because it's kind of hard, if you don't get in early enough, it's kind of like McDonald's was always first because they were there first. What are y'all going to do to assure that you tap into that massive market that we're going to see? And remember, they created 1.2 million net new households last year. Go back to your housing plays. Supposedly they're going to do that every year for the next 14 years because we're just starting to see the first part of the millennial. So what's your strategies on latching onto this massive growth market via your REIT or your non-REIT model?
Well, we're a large owner of suburban office buildings, and the fashionable thing to talk about is millennials all moving into the cities, and they're never ever going to want to live in the suburbs ever again. But my own view is that if they grow up and have children, most of the inner city school systems might not be up to the task to educate them the way they want their children to be educated. And they might find that they have fond memories of when they were children, being sent outside to play. And the trend might actually go the other way. So I think that suburban office is really out of favor right now, but it's probably not so bad as people think. And whether all of these millennials are able to form new households is we'll see. I mean, my own view is that with investment yields so low, it's going to be really hard for people to retire. Right? I mean, think of how much, if you invest your money at 2% in bonds, think of how much money you have to have to eke out an income. So, it may be that people don't retire, and that doesn't free up as many employment opportunities for that millennial. And, if they're not working, they might not be moving out of the house. So, time will tell.
I'll pick up on that because I think every market's a little different, and we're starting to see that trend. So I'll tell you. So when I started, as I said, 16 months ago in June. I'm on a planned trip to Spain. I finalized my contract in the Prado. I leave my wife and mother in Spain and come back and come to work. And it's a REIT conference in June, and we're invited to a city conference just to what we thought was going to be an introduction. So we decided I only knew one person, and I should get to meet my CFO, the two people running the multifamily business. So we meet in a bar before, we introduce ourselves, we walk into what we think is going to be a room with 10 people, and there are 45 analysts sitting there firing questions at us. We haven't been to the office. Turned out we did more due diligence than people thought, and it got us off to a good start into the conference. But the part that I addressed had two theories, and people said, why'd you take the job? I said there were three reasons. One, extraordinary board led by Bill Mack, who's really a great citizen of New York and a great businessman. But I said also, sitting across the river in Brookfield where I came from, I really thought that there was tremendous potential for the Jersey waterfront, and it was poised at that moment. And then I started to advance the argument that you made, that when I was at Brookfield, which was all on the side of the business I was on, office properties was all focused on Center City, and they'd only make an investment to the extent that we saw 18 and 24-hour characteristics in the city. And I spent time with Brookings and other people on an academic basis, and we saw, if we went into, you saw retail and restaurants and housing and transportation coming, but the one question that no city was able to answer was education. And it was starting to worry. I was starting to think about it. So I said, I really felt that you were going to see what you were talking about, the older millennials start to move. And then we sat down, and our second conversation as a team together was, well, how'd we do? And they said, hey, look, everyone bought that Jersey City argument. Nobody bought the suburb argument. But 3-4 months later, having nothing to do with me, the literature, the research, and actually the activity started to change. And it went from the suburbs were dead to the suburbs aren't dead. In fact, there was a terrific report issued last week by ULI where they coined a new term called surbans, where they said that, yes, all the millennials want to live an urban lifestyle, except they're going to be living it in the suburbs. And those are the kinds of things that we're seeing and that we're doing, that we're bringing. So, I said there are winners and losers, and then there are others that we believe are going to be winners. So one of those is Parsippany. Why do we believe Parsippany is going to be a winner? Not as clear, not as clear cut as the Short Hills. We believe that it's proximate to transportation. But then when we went to, and we have a great business park there, and we went to the mayor of Parsippany, he says, look, I have one dream in life. I want a town center. He says, it's a little bit first. I have everything. I've been the mayor for 20 years. I'll really work with you to create a town center. So we had 2 office sites, which made no economic sense or likely to be economic sense to build out in the next few years. And we're going through a process now. We're going to build workplace affordable housing with an affordable housing component. We're going to build a hotel. We're going to bring in significant retail. And then we're going to go through buildings by building, and we're going to upgrade the food, we're upgrading the gyms, we're putting in walking paths, exercise areas, and all those kinds of things so that people will be able to get to work and bring that environment that'll be appealing to them. And in anticipation, we've been able to move the occupancy about 400 basis points.
That's quite a bit.
In a short period of time.
Anything else on that topic?
Yeah, I mean, for us, it's not something that I think impacts our business model immediately right now. I mean, certainly in underwriting assets, you got to take all that into account. And we bought a building a couple of years ago. It was Kraft Foods headquarters in Northbrook, a suburb of Chicago. It was a sale-leaseback. It was a 10-year lease. It was a suburban asset, an asset that was a 1990s vintage, but one in which Kraft had really kind of reinvigorated it as their corporate headquarters. Very modern floor plates, workstations as opposed to offices, including the CEO and the CFO were in workstations. Meetings happened in conference rooms as opposed to private offices. So we liked that. It came into certainly our underwriting. But what was more important to us, I think what I've mentioned before and what will continue to be more important, was the basis at which we were buying that asset. We came in at $100 a square foot. We had rents at $7. We did have a 10-year lease, which we would prefer to be longer, but we were comfortable with that underwriting. But we also thought these guys were going to be there for a long time. This was asset they had put a lot of money into, and it was a great campus with a lot of amenities. Next thing you know, they get bought by Heinz, and who would have thought that Kraft Foods would have changed hands? And then the next thing you know, Heinz is going to move them to Pittsburgh, and anything they have in Chicago, they wanted to move down into the Loop for two reasons. One was to try to bring in or attract a younger workforce, but also they wanted to downsize, and they thought that they would have some natural attrition. I'm reading this a little bit. They'd have some natural attrition by moving out from a particular location into downtown. So at the end of the day, what mattered was the basis. We ended up settling with a lease termination with Kraft. I think they paid us more than the remaining rent due because they would have had substantial operating expenses as well. We also got a little bit lucky. Again, the basis worked out where we had an owner-user that wanted to use it as their corporate headquarters. So we ended up selling that asset 3 years after we bought it for $70 million, and we netted about $92 million between the termination and the dark sale. And a little bit lucky in some regards, but I think we generated our own luck by looking at basis and lease structure. I think that was most important. So, how it plays in millennials, I mean, it's real, in the short term. I think you're seeing that that flight to the, to a certain lifestyle, especially for companies that want to attract the younger workforce. But in the long run, I agree. Millennials are going to grow up. They're going to want families. They're going to want to have the experiences perhaps that they had when they grew up, growing up in suburbs. And, you're going to see that trend perhaps reverse.
Yeah, time will tell. We haven't lost, and we've had tenants move out of office buildings, but we haven't had one yet leave a suburban building for purposes of moving into a city. Maybe we've been lucky, but so far that hasn't impacted our business much. It's a good story because if you think about it, a combination of the right basis, but also the long lease term can be an incredibly valuable thing. Because think about it, if we have a 20-year lease, what's the chance you're going to change your space use decision exactly 20 years from now? I mean, business might be terrible in 10 years, in which case you want to shrink, or maybe it's great, you want to expand. But the nice thing about that long lease is there's this long period of time where something's probably going to happen that leads to a negotiation with the landlord. And that's really where you can advance.
Yeah, and the other part about that
economics.
long lease, and we have a big portfolio, so we see just about everything that could happen to an office building, happen. And one of the things, when you have an asset that is no longer critical to that tenant, and it's under that 10, 12, 15-year lease, instead of just leaving it dark and waiting for that lease to roll, if it was 2 or 3 years, they'll be proactive. They'll put some money into it. They'll look to sublease it, and they'll do a lot of the work for you that you would have had to if you took it over. So there are benefits of creating those long-term structures. And then at some point, you can just recut a deal. If you like what they've done to the building and they have good tenants, you then can cut out that tenant and go direct with the subs. And, and for us, that's an asset that maybe we hold or maybe we then exit to a multi-tenant office buyer.
If you talk to the life insurance companies, and the life companies are still our primary source of big dollar money other than the capital markets as far as REIT formation, equities, and what have you. But the big life companies have really changed their focus from 2007 to today. We can all remember the 2007 heyday of the 3-year CMBS, collateralized mortgage-backed security. The life companies today said they didn't want to touch anything less than a 10-year term on any mortgage. But life companies have changed their focus on this. They're now more focused on tenant quality than any time before. Is that impacting y'all's business too? From industrial to office to multifamily to single tenant, quality of tenant?
I'll jump in just for the hell of it. Look, we only do investment grade tenants, so we only borrow from life lenders, and even during the depths of the credit crunch, financing was readily available. You couldn't borrow, high LTVs, but credit was available. So CMBS, yeah, that's a more skittish market, but we're not at all dependent on it, so I'll rely on the rest of the panelists to address that. But just thinking about the millennials for a second, the guy had a chart earlier, he was talking about Ray Kurzweil and Moore's Law and computer processing power doubling every 18 months. And thinking about that and what that means for real estate, I think it was Will Rogers, everybody quotes saying, buy land, they ain't making any more of this stuff. And now you have virtual space. You have IP addresses, trillions of them. You have cloud storage. You know, you could digitize so much stuff and put it up on clouds. And like that chart showed, it's only going to grow exponentially. So, you know, we're talking about real estate with a kind of a backwards mindset. But looking forward, you know, there's certain property types that are already seeing creative destruction, and certain property types that are seeing the stars lining up favorably for them. So, you know, it's exciting time to be in modern industrial buildings. 3D printing, we have GE's global headquarters for additive manufacturing, which is 3D printing. It's where they do all their research. Where is it? It's in Pittsburgh, near the airport, because Carnegie Mellon has all the talent there. So, you know, you really want to be, when you talk about millennials, you want to be, and millennials, when they shop, they think a shopping cart is an icon on your computer. You know, the most valuable real estate for a millennial is right on your smartphone. You know, they're just glued to their smartphone. They could buy anything, anytime, anywhere from their phone. So you got to start thinking about real estate a little differently than just land and its improvements.
I mean, and to the last point Michael was making, yeah, and I don't know, how far-reaching this is, but you really have to pay attention to where they're moving as well. So I know this applies to the New York area and the Bay Area. Can't speak to the other cities, but if you look, and we had I had an intern survey all the residential brokers in North and Central New Jersey and in Westchester County, and say, you know, where's the activity? If you want to know where it is in Westchester County, New York, go watch Girl on a Train, which the book took place in the UK, but the film was made along the Hudson River. And there are a series of towns there. I've lived in Westchester for 20 years. I don't know anyone that lives in those towns, Ardsley, Irvington, but this is where a lot of the people who are leaving Brooklyn or Queens or Manhattan to buy their first house are moving. And why are they moving there? Because there's a train station that's close. They can buy their first single-family house for somewhere between $700,000 and $1.2 million or $1.3 million, which for New York is an entry point. And each one of those towns has a really quaint street with a bookstore and a coffee shop and other places that they can go. In Jersey, it's Montclair, it's the Oranges, it's Red Bank, which I know of, very popular places, but those weren't traditionally. It's not Short Hills or Greenwich or Scarsdale quite as much.
Back to your question about sort of financing strategy in life companies, the nice thing about being a public company is that you have lots of choice. And we're an investment grade rated company, so most of our debt is unsecured. But we tend to, it's a mix of bank debt and bonds, and where we borrow money from life companies is when we can get great 15 and 20-year financing, and that's where the financing is better than in the bond market for us, but it's, really trying to have the flexibility to make the right choice. But we're less and less about financing at the asset level and more about financing at the corporate level now.
Well, since we have, did you want to comment?
No, I was just going to echo. We're in the same boat. We're committed to an unsecured strategy. We have an investment-grade balance sheet. It provides lots of flexibility with the asset base if you don't have secured financing. The benefits of secured financing obviously are the non-recourse nature of it, to the extent you make mistakes, but you hopefully that doesn't happen that often. So, we like our strategy, but there are times certainly when the non-recourse debt makes sense.
So we have a lot of brokers in the room, a lot of tenant reps and what have you, and y'all are so diverse in your property types. How is it different for any specific deal, whether you're dealing with a publicly traded REIT, a non-traded REIT, high net worth individuals, or even institutional investors? How does that change the interaction of the broker in the field that's either buying or selling your properties, assuming you're acquiring and selling out? What strategies do you use in this, and what do they need to know the difference between each of those different entities?
Well, I could start here because we have a little bit of, I wouldn't say a little bit of everything. We certainly are a public REIT, and we have the investment management business, which is comprised not entirely but mainly of non-traded REITs. One of the misconceptions about WB Carey is that we are really this non-traded REIT, but I think the latest through June, I think 94% of our AFFO was generated by our public REIT, and only 6% of the AFFO contribution was coming from the investment management business. But in terms of the perspective for those in the room, one of the benefits that we really believe in about our model is the fact that we are diversified. And I talked before about asset type and geography and tenant industries, but we're also diversified across access to capital. When public REITs are trading up, it's a great place to, they're going to have the lowest cost of capital. They're going to, as a result, likely be able to pay the most or find deals that have the lowest yields and still are accretive to their portfolio. And that's great when the markets are cooperating, but that's what a public REIT is. It's gonna live and die by its cost of capital. And when you hit points in time like we did in 2008 and 2009, it was very difficult for any public REIT to be active in the marketplace. WB Carey stock, like probably others on this panel, we went from the 30s down into the teens in a matter of time, and certainly the equity markets weren't open. Any kind of debt offerings that you wanted to do wouldn't have made sense either. But we did have this investment management platform. We had a long track record of sponsoring and running non-traded REITs, really going back to the 70s. The company was founded in 1973, and in 1979 we raised our first, we did our first fund at that matter, and 17 funds later we're still doing the same thing in that space. I think we've averaged 11% returns throughout all of that 40-year history, net of all fees. But why that was so important to us was in 2009, we were still raising a couple $1 million a day, and these were from investors that didn't want the volatility of a public stock. They wanted the income, they wanted the capital preservation, and they didn't want to have to look at their account statement every quarter or every month or every day for that matter and see these massive fluctuations. And the benefits to us is that non-traded REIT, that's a really consistent, constant cost of capital. These are absolute return investors. They're looking for, call it a 6 or 7% dividend yield, capital protection or preservation, maybe a little bit of appreciation as well, and call it a high single digit, low double digit total return. So we were still raising that money there, and as a result, when there's times of distress, obviously that's the time when there's the best deals, and we took advantage of that. We bought some great assets in 2009, including the only asset that we own in New York City, or in Manhattan at least, the New York Times building at 11% cap rate at $300 a square foot on a 15-year lease, when that's probably worth $1,200 a square foot right now. So those are the benefits. I mean, clearly the negatives are that it has a perception at point in time. There's always been bad actors in the space. Clearly there's been some of that more recently as well. Some of the biggest players tend to be the ones that that raise the most money, and then also are the ones that blow themselves up at some point, and that cycles through, and we got to deal with that. The new regulations that have been coming on board, it's impacting fundraising, but in the long run, that's going to be good for all the players, and people like Blackstone coming into the industry adds credibility. I think Cantor Fitzgerald's getting in the space. Colony is. Ares has been, or Apollo has been talking about it as well. So all reputable firms that I think will lift that. And we're going to stay in that space because we think that capital is going to be there. There's going to be retirees that are always looking for that income and capital preservation. It's a good capital source for us. I think it's going to become a smaller and smaller component of our business. Like I said, it's less than 5% right now, and it'll probably become less than that, but it's still one that we want to have access to for those points in time when you really can't access capital in a down market. And I know I'm rambling on here, but one last thing. I mean, the importance to those in the audience is that when you come to someone like us that has this diversification in capital sources, that they're well capitalized, that they can deliver. They're not going to walk away from an asset at the closing table, and I think that's probably what's most important out of anything is good pricing, of course, but unless you close a deal, the pricing doesn't matter, and that's one of the big benefits of having this diversification of capital sources.
I think it's certainty of execution, so I agree. And it sounds really great to say we're going to sell an asset to a high net worth individual at a higher price than somebody else is going to pay, but if that high net worth individual is trying to complete a 1031 exchange, they might have identified 2 other alternatives for their exchange. So, you might roll the dice and end up with nothing, in which case you might be calling us
we'll come in
back.
at the number 3 or number 4 bidder.
Yeah, and so we often win business when we're not the number 1 bidder.
Yep.
And we love getting that call that says the deal fell apart, are you still there?
Right.
Right? We say, well, maybe.
Just to jump in to add to what they're saying from a more macro standpoint, REITs have access to all 4 quadrants of the capital markets, public and private equity, public and private debt, and there's times when REITs trade at premiums to NAV and they have a competitive cost to capital advantage, and times when they don't. Commercial real estate's about a $10 trillion market in the US, and the REITs represent about 15% of that, about $1.5 trillion of total value. And public markets are usually more efficient because they're liquid markets. You could buy and sell in the open market. And because we're only 15% of the commercial real estate market, we're not that efficient. The private market is far more efficient than the public market. And on top of that, in this low return environment, all the money is flowing into passive, mindless, algorithmic, formulaic, spreadsheet investing. It's not stock picking. It's nobody doing the research to discover a discounted value play. That's too expensive. You got to pay a huge fee to hire somebody to do all that work. And it's a low return environment, and you can invest. I think it was just announced BlackRock now has over $5 trillion in AUM in their index funds. And the cost is like 9 bips to give them money and throw 1 dart at the whole board. And that's how people are investing these days. And from the brokers, you may like this, but it's not real. It's very synthetic. But you've seen companies go public at 200 million. You blink your eyes and they're $20 billion because they went on this feeding frenzy. And it works. On Wall Street, it works because these indexes buy high, sell low. The bigger you are, the more they have to own. So you go out and buy things, and then you have a lower cost of capital, you have a higher multiple, but the tide invariably goes out and you have vacancy and you realize what you really bought. So, again, that's to my point earlier about the ever decreasing time horizon, that everybody's focused on short-term, not even quarter-to-quarter metrics, more like, nanoseconds. So the people who are long-term investors are clearly in the minority, but that's in the long run where the alpha is generated. You want to buy quality assets. You don't want to grow for growth's sake, even if the computer robo-investors will reward you, because active investing will come back, but that's where we are right now in the cycle.
So lastly on this kind of general topic with broker, in any of these types, whether it's the high worth, publicly traded, non-publicly traded, institutional investor, your tenants will be treated differently, or will they be treated differently depending on the type of deal it is, on build-out allowances and things like that? Do the brokers need to be sensitized that we may act differently than we've typically act because this type of owner does things not in the same form? I mean, do you see any one of these individuals giving you much higher or much lower build-out allowances for tenants?
I mean, I'll jump in. Where we are, it's very much market-driven. You've got a sophisticated brokerage population. The people who are doing most of the deals understand where the market is, understand what the concession packages are. In multi-tenant office buildings, the level, actually, the deal sophistication is greater, but the deal structuring often is less, because all you have to know is cash and gap. And everyone, who's practicing here understands, how to formulate both. But we're not seeing most, and we've actually on the Jersey side of the Hudson, we've been able to keep our concession packages relatively flat while enjoying rent growth. While what's happening in Manhattan right now is that pricing kicked up so aggressively that people, with a goal of preserving some of those higher face rents, have increased concession packages fairly dramatically here.
So, anyone who's ever traded stocks, and we all probably have equities, have you ever heard the person that never lost money on any deal? And you know they're lying, am I correct?
As long as they didn't sell.
What's that?
As long as they didn't sell.
Yeah, as long as you don't sell, but I've seen stocks go bankrupt too, so. Yeah. Tell me what's your speed of strategy that you have to have and strategy you do utilize when you have this deal that doesn't perform like you need it to. What do you do? How quickly do you do it? What type of team and outside talent do you use? Do you use appraisers? Do you use ULI people to help you turn these properties that are performing substandardly? Or sometimes it's just wait and see because the market's going to say it's not ready today.
No, it depends. Every situation is different. I think we've been a public company 23 years. We've had 7 lease defaults where we lost money. So that's where these single tenant deals go bad, and the IRR is almost, it can get underwater quickly. So from a credit standpoint, we've been pretty good. It depends on the market. In a lot of cases, we've probably, because we're a mature company, we've probably had more end of lease, conversion to multi-tenant, redevelopment, and everything else. And in some cases, depending on the market, we're able to do that ourselves in-house. And in other cases, we'll probably sell vacancy to somebody local whose business is working assets like that. So it's kind of a mix of outcomes depending on the asset and the opportunity.
I mean, one of the misperceptions of net lease is you buy the asset and then you hold it. You get rent payments quarterly or monthly, and then you wait for that lease to roll, and then you figure out what to do with it. We've been around for quite some time, so we've certainly had our share of lease rolls. We hold assets for a long time, but we don't fall in love with an asset, and I think that's important. You can't be wed to your original business plan because things do happen and tenant needs change. One of the things that we really emphasize within our organization is active or proactive asset management. We're reviewing every asset every quarter. I think on our balance sheet we have over 900 properties. In our managed funds we probably have another 900 properties. So it's quite a bit. We have a rating scale. We rate everything based on its the tenant credit, the quality of the real estate, and importantly the criticality of the asset to the operations of the business. And if there are changes in some of those things, we'll start evaluating what to do with that asset. Especially with criticality, that's something that we want to be able to extend leases. We want to be able to put more capital into buildings and get lease extensions that way well before they come due. Recent example, we own an asset that we did with a private equity-backed company in 2005, Piscataway, New Jersey. I think Mitch would agree it's not a great market. But we had a 20-year lease in place, and 7 years into that lease, the private equity firm sold that business to an investment-grade company. It was BBB+. So we got a great credit upgrade. You talk about net lease being like bonds. Well, this isn't callable, and that's one of the big upsides you see, at least where we focus in sub-investment grade space. But when that company bought it, we restructured that lease. They wanted to redo the building. Again, they wanted to make it more of a modern building. It was a tech company that owned it. So we put some capital in alongside them. We re-extended the lease from, I think it was maybe 8 years left or 9 years left, back out to 15 years. And then a year later, like a lot of big companies, they realized, we have a business in Boston. We got a business in Texas. We think that that's where we want to consolidate our businesses. So they signaled to us clearly that they didn't really need our building. We had, at this point, 13 years left in our lease, investment grade credit, things that a lot of net lease buyers would love to get into. But we knew that these guys weren't going to be there. Our rent escalations outpaced the market, so we were probably 15 or 20% above market. There's vacant telecom buildings littering that place left and right. So we decided to get out of that asset when there's still a lot of good metrics in place on that deal, and we sold it at a great cap rate to another net lease buyer who wanted the income and didn't really care about the residual risk. And so I think at times you just got to be willing to change your strategy and not get wed to a particular asset, especially when you have a lot of the fundamentals on the real estate side that go a different direction.
When we started, we announced a 100-day plan, and which we delivered within that timetable, and we have just been aggressively executing it. And as I said earlier, it was part of it was a rationalization of the portfolio. We surprised people because we actually were a buyer before we were a seller. People thought we were going to just be a seller. We are a net seller. We identified those assets that we felt were a distraction, not part of our core strategy, and we've been moving them. And we'll have moved almost all of them by the middle of next year. We've sold about $450 million worth already, but another 250, 300 should close by year end. We got great service from the brokerage industry in the different markets, and we spread it among several firms, and we didn't wait for the last dollar.
Smart. So my next question, I've done a lot of work in property taxes, and I actually teach each year at the Institute of Professionals in Taxation, IPT, and we have people that come to us from CBRE and Colliers and Cushman and NAI, and they do a lot of property tax work for institutional investors and other firms such as yours. One of the people in that argues that REITs can pay a higher price than non-REITs because of the tax advantages and the net cash flows. And then he also argues that because of that, REITs actually have to spend a little bit more due diligence in really monitoring those property taxes. Do you all do a systematic ongoing? Do you use an outside person for property taxes? How do you handle property taxes? And are property taxes higher amongst REITs than non-REITs? Because they pay more.
We're all net leases. Taxes
Tenant's
are
problem,
borne
right?
by the tenant. We try to work with the tenant and help them because it's part of their overall occupancy costs. But, I'll defer to people who have other than net leases.
Well, we want to make sure that our buildings are always as efficient as possible, and so that our tenants are paying the lowest taxes possible. So I don't think that REITs, boy, if we're paying more taxes than other people, we sure
I hope
are
we're not
schmucks.
overpaying for assets too much, but
Yeah.
Yeah,
So I don't think so.
yeah, I don't think we're paying more either on the asset or the tax side. And we're in multiple municipalities, and the situation is different in each one. And as you can imagine, we engage in someone with expertise in each of those markets to bring certiorari proceedings or tell us not to.
So we just had a, kind of a deal changer a little bit for corporations that had real estate inside, and they were operating corporations such as Target, where they own their buildings. And we always saw these spinoffs that would take out, and you could give your REITs to your shareholders, your real estate to your shareholders in a REIT form, more efficient way of holding. The IRS has come down and saying, at least through 2019, we're not going to allow that. A, has that impacted this business at all? And B, is that a catastrophic event? If the IRS were to pull the REIT's favorable tax status, what would the outcome of that? And are there any other pending catastrophes that face your industry? In title insurance, for example, roughly 60% of our revenues come from houses, 40% from commercial and our direct operations. As long as Fannie and Freddie like title insurance, we do too. But to see maybe a change from an institution or a government agency like that might alter the demand, you always have a strategy in place to handle that. Any of those facing you all, any impact on these things? And are you at all concerned that maybe under a new government regime, you would see a real search for new tax revenues and they're going to grab anyone who has money in their pockets?
The OpCo-PropCo structure, they're kind of, the PATH Act has taken away the ability to do so. So it's very limited. As you said, in 2019, you cannot do it. But one of the tax reform bills had an elimination of 1031 exchanges. That would be terrible. Yep. That would definitely be a problem. But look, public REITs have outperformed stocks and bonds in 16 of the last 23 years. That's 70% of the time. REITs are the best performing asset class. So it's a good way to invest. It's a good way to take your real estate put it in liquid form. It's the best way to own it and manage it. So I don't think the REIT vehicle is going away. It's now in 35 countries. They're copying what we've been working on since the 60s. So REITs are a mainstay. And if you think about the legislation over the decades from when it was conceived, it's only gotten enhanced and fortified and modified to the shareholders' benefit. So, REITs are a great way to own real estate. I think if you see any signs of Fed tightening, there's going to be a lot of short-term capital flowing out of real estate, out of the public REITs, and you'll be able to buy real estate cheaper on your computer than on Main Street, and those are exciting times.
Yeah, in terms of the OpCo-PropCo, I mean, for us, a large part of our business are sale leasebacks, so we see that as an opportunity. I mean, if you can't spin your real estate off into a new public entity, then you may look at other ways to monetize or return capital to your shareholders, and that could be through sale leasebacks. Clearly, it's not as tax efficient as it would be for a spin, but all depending on how motivated they are and the specifics of their portfolio themselves, but that's an alternative, and so we see that as an opportunity. Does it happen? It depends on the company. I mean, I don't see McDonald's doing lots and lots of sale leasebacks. I think to the extent it worked to do to spin their real estate out, perhaps they would have done that.
In this climate, you have the opportunity, take it as an investor audience, really to have a greatly competitive total return. So you get a dividend. It could be from 2 to 5% wherever it is, and then you have the opportunity, because the way we're viewed, when we started, you have the issue of calculation of NAV, and then is there a discount to NAV? And as analysts look at you, sometimes there's a legitimate reason for the discount to the NAV, and sometimes there's not. And when I say there's not, it's hard to understand. And so, when we started, we had a dual challenge. We've been able to increase NAV, and we've been able to decrease the discount to it. Now we're working further along that. I think other REITs have those issues to varying degrees.
Yeah, those are great opportunities. Sometimes it could be CBL. They went after Bob Corker, a senator from Tennessee, and suddenly you could buy CBL at 40% discounts and realize a 40, 50% return in 6 months. So Mitch is absolutely right. It's not real estate related, and you could swoop in at fireside sale prices because it's a small part of the commercial market.
So we have 2 minutes left, and I'm going to give each of you 30 seconds, and if you don't know what you want to talk about, then answer this question. Will it make any difference to your business if Donald or Hillary wins the election? If you don't want to talk about that, talk about what you want to talk about. So I'll start out with you. How does that sound?
I am going to go with the consensus on it, that I think there will be, were Trump to win, there would be significant uncertainty thrust in the marketplace for a period of time. No markets, particularly real estate, enjoy uncertainty. So we've had a little bit of a pause in this area in certain parts of the market, and there's a lot of feeling they want to see where this all sorts out. Not that there's passion for one candidate or the other. It's just it's a walk into the great unknown.
No change. I view the next president as a caretaker who's probably going to be a one-term president. I think Congress will be divided. Next to nothing positive will get done from a legislative standpoint, and there you go.
No change, same old, same old.
I mean, speaking of Trump, I'm looking up at these screens up here, and I guess you guys are looking up there, and I can see why he looks orange on TV. I mean, I don't think I quite look this way normally, but hey, yeah. I mean, I'll echo. I think what what's just, or at least what Mitch had said. That I think if it is Trump, I think it does create a lot of uncertainty and probably period of chaos. I think people just don't know what to expect will happen, and so that volatility is not good for REITs. To the extent it's Hillary, I think that's probably something you'll see some more capital inflows coming into REITs, and will probably outperform. And that's good. Whatever can help the cost of capital is going to help you grow, and so we would welcome that.
It's very binary. You have one candidate saying lower taxes, the other saying higher taxes, one saying less regulation, the other saying more regulation, one saying drill, 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 the other saying climate change is the biggest issue ever. The media won't allow real issues that need to get aired and deep discussion. They want to talk about titillating nonsense, and I don't think it's going to end on November 8th, sadly. So start storing water in your basement and money under your mattresses, and go buy a gun,
Ladies and gentlemen, would you join me in a round of applause for these great